Yeah, we call it the ABC, the anything but China trade.
So, of course, China is very, very large. They make like $1 trillion of electronics. So they're very large, but I think even a fraction of that in specialty chemicals, in engineering, in electronic manufacturing, in defense production. Even if a small part of that comes to India from where we are, that's like doubling the business or tripling the business, right? So the thing is manufacturing in India, infrastructure, consumption, domestic pharma, global pharma, insurance, financialization of savings. There are just so many sectors that are participating. And as a manager, I can look at the addressable market expanding for each of these businesses over the next 5 or 10 years.
Welcome back to Alpha Uncovered. My name's Alvin Fan, CEO of OPIM. In this episode, we have the pleasure of speaking with Mr. Rajesh Bhatia, the Chief Investment Officer and CIO of ITI, the Investment Trust of India, where he manages an outstanding long-short equity fund over the last 6 years, outpacing and beating the Nifty 50 since inception. This is a domestic fund, of course, but he recently launched an offshore fund in Gift City, which will allow offshore investors and international institutions to participate. Rajesh has over 2 decades of experience in investing both long and short in the Indian equity markets, hence the absolute return nature of his strategy. Before joining ITI, he was the CIO of Simto Investments, a subsidiary of Tata Investment, where he managed the equity portion of the treasury and proprietary funds. Rajesh was also the co-founder and CIO of Heritage India Advisors, the Indian advisor to a New York-based equity long-short India-focused fund, Heritage Capital. Heritage Capital was nominated among India's top 5 funds by Eureka Hedge in 2010. Earlier in his career, Rajesh set up and ran Portfolio Management Services, PMS, business for Reliance Capital as Senior VP and CIO. Please give a warm welcome to Mr. Rajesh Bhatia. Rajesh, I want to dive into it. It's really good talking to you. We always have a great conversation talking about India, Asia, macro, in particular because you're probably one of the most institutional of managers, not just in India, but compared to many managers that we've met here across Asia. Your book is extremely risk focused, which is the type of strategies that we'd like to talk about here at OP. So let me tee it up for you. We're here talking about India, of course. Nifty's up roughly about 15% year to date, up more than 30% in the last 12 months. Your fund has really knocked it out of the park. You're not that far off year to date, and you're definitely beating the Nifty, I think, on a 12-month rolling basis. I think for those of us who are outside looking in, especially for investors who are meeting you for the first time, how would you describe your strategy in a short few sentences? And then I want to talk about what the differences are between how you approach the market and how the rest of the managers look at the space.
Sure. So, if I had to summarize what our strategy is all about in the ITI long short equity fund, the idea is that we want to participate in the equity market of India, which of course is in a sweet spot at this moment with the numbers that you just pointed out. It's a bull market here. So we want to participate in the bull market on the upside, but as you pointed out also, that we are extremely risk focused. So as we go along that journey of participating on the upside, we want to make sure that we don't lose money. In fact, to the extent we can, protect capital as we go along, as markets decline in any sharp way. So that's what is really the idea, to participate on the long side, not participate as much on the downside. And as we traverse the journey, you would actually could do equity returns. In fact, hopefully better than, it depends upon the nature of the rise and the falls, but over a period of time, actually do better than the markets. And in fact, if we could even do better than the long only funds with much lower risk and much lower volatility. So that's really the essence of what we are trying to achieve at ITI Long Short Equity Fund.
When we look at India, I'm sort of reminiscent of what we saw in probably the early parts of, say, not just Japan in the 80s and 90s, but also more recently China. And it's not uncommon that I hear a general concern that especially after a fantastic 2023 and a stellar 2024 so far. A lot of investors are, I guess, nervous about coming into a market that's already so heated. There's a lot of discussion about, leverage, about are we overheated? You made a point that we are in this space today, as of today moving forward, looking to participate in the continued upside in the India market. Can you walk us through maybe a couple of demographic numbers as well as some macro numbers that suggest to you and give you that assurance that we are nowhere near the peak and that we still have, I guess, a lot of juice for the squeeze, so to speak?
So demographics is quite long term, I would say, but that's also interesting because 50% of the population of India is less than 35 years old. So, of course, we know that over the long term, for GDP growth, you require more hands and increase in productivity. That's what really decides the delta or the increase in GDP. So we have clearly will have more and more hands actually joining the workforce, and that will be kind of a tailwind to GDP over a longer period of time. But let's say even if you were to take the shorter term, what I mean by that in terms of shorter term cycles, if somebody is not very familiar with India, this is what I would say. Between 2003 to 2007, we had one of the longest economic expansions in India. The last 3 years of that economic expansion was 9% GDP growth rate. This is real GDP growth rate. Nominal was much, much higher. That was a fantastic time. Of course, it was a globally synchronized bull market. In India, it was a capital expenditure driven bull market. And of course, it ended in Jan 2008, inauspiciously marking one of the worst years in equity markets in 30 years, which is the year 2008. Again, that is something that the globe also saw. From 2009 to 2000, I would say 20, the Capex cycle was dead. The banks were saddled with a lot of non-performing assets, and so they were all cleaning their books. The corporates were saddled with a lot of debt. Again, they were clearing all their books. The real estate cycle was dead, so on and so forth. What took off from then on was really the consumption cycle. So the consumer was the one which actually took up the mantle, and consumption stocks did extremely well between 2009 to, let us say, 2020. Now, the capital expenditure cycle was dead for a long time, which means you had underinvested in capital expenditure. Fortunately, the bank, which had been writing off all their bad loans, became light again as far as their balance sheets were concerned. Corporates, which had been repaying their debt, again became light as far as their debt equity was concerned. So the corporate balance sheet, the bank balance sheet became extremely healthy. Unfortunately, at that time, the COVID struck. But as a response to the COVID, what the Indian government did differently, and I would give a lot of marks for their macro management of the economy. We have had a very, very steady macro for a long period of time in India. But as a response to the COVID, what it did was it started focusing on road and railway capital expenditure. So while they fed 80 crore people, 800 million people free food as a response to COVID, unlike the developed world, which actually gave money to everybody, what the Indian government did was start the capital expenditure cycle again. So if you look at the government's fiscal, their capital expenditure as a percentage of GDP, it's the highest now in the last 2 decades. That has driven a capital expenditure cycle. Usually these capital expenditure cycles last 5 or 7 years. So, let me give you an example. The power sector is become a growth sector all across the world thanks to AI and data centers, but we are at a deficit at this moment. The peak power is at a deficit. We will have to go from deficit to surplus. By the way, the power demand is growing at 7 to 8% per annum. That's volume. That's going to be a growth business for the next decade or two. We will require $500 billion of investment just in the power sector alone. Generation, transmission, and distribution. So this is a capital expenditure driven cycle. It lasts multiple years, and along with that, earnings will also expand. So that's the nature of the markets that we are looking at as we speak.
When we look at Capex expenditures and when you sort of position yourself looking at the ball, in other parts of the emerging markets, there's a great participation in government expenditure. Do you look at the split between private and public sector when you look at the velocity of the Capex?
Oh, certainly. So in the GDP equation, the central government is really the one which takes up the mantle when the other parts of the economy are not doing well. So what happens is that once the GDP kind of accelerates thanks to government expenditure, private expenditure, private investments will follow. So when you're talking to banks, already they are telling us that we are seeing an increased willingness and a pipeline of private sector investments to follow. So I think it's both the public expenditure and that is going to be followed or is already being followed by private investments in the infrastructure or the capital expenditure cycle.
Wow, that's massive because that gives you a pretty big menu to pick from, right? On one, where some markets, including US, you go through these growth cycles, right? Where growth names and innovation tend to do well as they did a few years back. And then they went through a cyclical phase where more traditional and cyclical types of companies, more bricks and mortar type of companies and industrials tend to do well. But it sounds like you have a pretty wide spread of choices as a manager. You can actually go into modernization of manufacturing on one hand, you can look at tech on the other. So stepping back now, looking at where we are now, time of recording, we're in mid-October, moving into Q4, State of the Union or the Union budget just came out. What's exciting you about the menu so far? And if I'm an investor, I have a feeling that yes, I could go with funds that manage the larger names, but I have a feeling that we're starting to move down the risk curve. Is that an accurate statement?
Could you elaborate on what do you mean by going down the risk curve, which is more
Meaning that we're moving from larger cap names, which have kind of saturated with the initial influx of capital, both from FDI and large institutional investors, moving down the market cap to say mid cap names or somewhere in between. I wouldn't say we're in the micro cap phase, but that's when we tend to get a little bit frothy.
Yeah. So let me give you some color as to how I'm thinking about this. One is, as you point out, there's a lot of sectoral breadth to this bull market, right? So whether it is the investment-driven cycle that we were talking about, that's doing extremely well. Whether it is the export-driven services business, that's doing extremely well. Whether it's the manufacturing side. Now, India is encouraging manufacturing or made in India. They're also betting on some shift from China to take place for geopolitical reasons to India. So
we call it the ABC, the anything but China trade.
So of course, China is very, very large. They make like $1 trillion of electronics. So they're very large, but I think even a fraction of that in specialty chemicals, in engineering, in electronic manufacturing, in defense production, even if a small part of that comes to India from where we are, that's like doubling the business or tripling the business, right? So the thing is manufacturing in India, infrastructure, consumption, domestic pharma, global pharma, insurance, financialization of savings. There are just so many sectors that are participating. And as a manager, I can look at the addressable market expanding for each of these businesses over the next 5 or 10 years. Now, unfortunately or fortunately, a lot of the high growth sectors, like I pointed out, the base is very small, which means these are small businesses, which means they're in the mid cap and the small cap sectors, right? That's where the action has been. The mid cap and small cap indexes have probably been twice as much as the large cap indexes. To some extent, I would say, people would say, this is an overvalued part of the market. In fact, there's a lot of froth in the mid cap and the small cap space in India. And the value now is actually back in large caps. So relative to where the India growth story is certainly happening in the mid cap and the small cap spaces, but in terms of valuation, they've gone to a level where people would characterize that as expensive or frothy. But as far as large caps is concerned, the Nifty 50, that is at 21 times 26 earnings, which is financially at 26 earnings, which ends in March. The 10-year average of that is 17 or 18%. So I wouldn't call that a bubble valuation, not cheap, but not bubble either. So the value has migrated in the large cap, mid cap, small cap space more towards the large cap as we look at the market today.
Interesting. So the way I understand your book, it's quite actively managed, meaning that you do have long-term holdings being long bias, but you also have a tactical approach, right? And from our last discussion, the way you look at it is to look at short-term, capture short-term price movements, momentum, and maybe some price dislocation. But at the same time, it's your way of also managing risk as well. So we actually just came out of quite a bit of volatility in the last couple of weeks, in the last month as well. You want to walk me through how you position or how you build the book to sort of mitigate some of that volatility?
Right. So typically there are 3 parts of our book. One is, as you point out, for the long term. We call that strategic long-term holdings. Second, the long book is the tactical long book. And the third part is the short book. So those are the three areas that we focus on. The strategic long book really focuses on multi-year themes, companies that we can predict over a multi-year period. These are damn good businesses with a good, attractive growth rate. I mean, India, you want to buy growth, right? Because the real GDP grows at 7% or 8%. The nominal GDP grows at 11%. Your private sector is growing faster. Your non-agricultural sector is growing faster. Typically, earnings, therefore, grow at about 15% per annum. So you want to actually at least want companies that grow at 15% or more, and that's on a multi-year basis, less cyclical, high ROC businesses. So that's really what we're looking for, the sweet spot, as far as our strategic holdings are concerned. The second is the tactical trade. Now, the tactical trades are also fundamental based, and it's a little medium term. But let me give you an example. So what happens is there is some norms that come out on the insurance sector, right, in the budget. And those sound very unfavorable to the insurance company. The insurance companies fall by 20 or 25%, right? But we found out that, look, these don't have as much damage as the market was perceiving these insurance companies to actually have. We can add them in our tactical book, right? We can buy them because they're now 20 or 25% cheaper. There are many slices to tactical trade, but that's just one example of the tactical trade. And on the short side, typically what we are trying to do is find companies with deteriorating fundamentals. So that's our sweet spot. We want basically the catalyst to be visible to us in the shorter term, which is in the next 3 to 6 months. The mind of the market, as we see it on those companies, should also move to a negative stance in the visible future, visible to us, which is the next 3 to 6 months. So that's the type of book that we build. Strategic, tactical long, and tactical short.
I think one of the most interesting parts about your firm's track record is how you manage COVID. So when I looked at the numbers, the most remarkable highlight from your track record was that same month in 2020, the market was down double digit, and your firm actually made money. You were actually net positive, which is absolutely remarkable. And the only times that I've seen similar type of performance are either managers who just started that year, and so they had not capital fully deployed, right? Or they were heavily underexposed, meaning that they were not yet fully deployed either as a new fund or even as relatively passive funds in some cases, or fixed income like funds didn't react the same way. And thirdly are active short focused funds. Now, I know your fund is long biased. Can you walk me through, maybe for a benefit, like what happened that month? And maybe like a blow-by-blow account, because it feels like it must have been a very exciting few weeks for you.
Yeah. So, we're talking about the ITI long short equity fund track record, which is now 6.5 years. But I was a long short equity fund manager even prior to that. And in fact, my career started in long short in Jan 2008, which was one of the worst years for equities in India. And even that time, in rupee terms, we lost just 1.5%. This was again repeated in 2011. That calendar year, the markets lost 25. We lost less than 2%. So we have a history of protecting downside. And I really kind of attribute that to two things that we do. One is we bring a certain top-down understanding of the markets, which is to understand where we are in the economic cycle, the earning cycle, valuation cycle, and the sentiment cycle. That helps us to know whether we should be on our risk-on mode or whether we should be careful about where we are. Are the markets cheap and oversold, or are the markets expensive and overbought? In some senses, to put it very simplistically, we just have a sense of where we are in the market cycle. Howard Marks has eloquently elaborated on that, but I think simplistically, that's what we understand. And the second aspect of our risk management is we are fairly aware of emerging risks. So in my experience, markets just don't collapse one day. I mean, there's only one unfortunate incident where I can recollect, let's say like a 9/11, where the next day the markets were down quite sharply. But otherwise, risk in the markets manifests itself over a period of time. And the market kind of is telling you, I am worried about this. The mind of the market is worried about a certain risk as it is evolving. To contextualize the 2020 episode, COVID happened in 90. It was COVID-19, right? But the markets fell in March 2020. It was telling you that this is a risk that we are really worried about, right? China shut its economy down on 15th Jan 2025, recollected. And by February, it had spread to other parts of Asia and even Europe. And the solution that they were offering is to shut the economy down. Now, we realize that 80% of the workforce in India is unorganized. If you shut an economy down, that has serious consequences for GDP. So we look at a emerging risk. We ask ourselves, can this disproportionately impact markets, right? And to the answer to that was yes, it can disproportionately impact markets. So in February itself, we brought our net exposure down very, very sharply. It was, in fact, at the end of Feb, it was 11% net exposed to market, which is as good as zero because the beta of our shorts is greater than the beta of our longs. So we brought our book down quite sharply, recognizing that this is a risk which can disproportionately impact markets. Our first dharma as a long-short manager is first protect downside. In fact, try and protect capital. So when we saw this emerging risk, we said, this can be trouble. So those are the two aspects that we look at while managing risk. The second aspect, where we take out the subjectivity, because sometimes people ask us, I understand you understand markets. I understand that you can understand risks that are manifesting itself. But what if your judgment is wrong? Am I restricted or a slave to your understanding of markets? So what we also have is a process layer. The process layer takes out my subjectivity when I'm managing my portfolio. So if the market is declining, I automatically reduce my positions, right? We are seeing our portfolio probably 5 times in a day. So we are aware of how the markets or our stocks are reacting or our portfolio is reacting to emerging risk, and we can reduce our risk in case we are moving closer to the negative range. And we understand what the market is worried about. So to some extent, we are able to understand and contextualize what can the downside be. So more recently, market has been worried about rising Middle East tensions, right? More recently, the markets have been worrying about India is not so attractive relative to China. So let's take some money off India and go to China, right? Markets have been worrying about the 10-year treasury yield has moved back up to 4% in the US. So we kind of understand what are these variables which are moving and can contextualize, is this a disproportionate risk? Can this impact markets in a big way? For the moment, while we continuously are monitoring these emerging risks, we don't think any of these events, so far at least, can change the macros of India. The only thing I worry about is really the Middle East tensions. If there was a much larger war,
That's
then
right.
I think,
It bleeds out, yeah.
yeah, then that's a different scenario. But other than that, as we speak, we don't think that this is going to disrupt macros in any significant way in India. So just to kind of close out what you just asked, this is how we manage risk, and that's what we were able to do in 2020.
So let me just anchor this point. I think it's quite interesting because now that I recall, there's actually a third or fourth type of manager that did well during COVID. And actually, there were quite a few Asian managers that did well, including India, simply because they took the China threat, the warning, far more seriously than the Western markets did. And so those who reacted quickly enough were able to deleverage and de-risk. Actually, they had plenty of time, if you think about it. To your point, China shut down mid-January. We had at least 2 months to start moving the book in that direction in CE to get ahead of it. Having said that, so that speaks to being on the ground and being in the region and being able to digest and interpret the information and to separate that from noise. I think that's really remarkable. And often it's more of an art than a science in trying to figure out whether certain emerging concerns or risks are noise or are they material issues, right? And what I find interesting is that you're one of the few truly fundamental based managers, but you think about macro very, very seriously. 9 out of 10 fundamental managers that I meet are very much agnostic to macro. So what that means is they say, look, we only look at the health of the company, the balance sheet, we look at the corporate governance, and we don't worry about macro. Instead, we focus on just great companies, right? So thinking back to your history and how you became a fund manager and becoming a professional, where did you come from? Did you come from more of a markets guy first? Did you come from a risk background first, or did you come from, a fundamental side? And then I guess the second question, what point did you start to merge the two philosophies together?
So, when I started my career, I was very fortunate to work with, actually classify them as the best investors in India. They made billions from the Indian stock market, literally billions of dollars. So I had a very close view of how to make disproportionate money from India. And these were proprietary investors. They were far, far sharper, very well ahead of their time. So I started actually with a fundamental as a bottoms up person. But what happened in 2007, 2008, when I was moving from one firm to another, I was actually a long only manager between 2003 to 2007, 8. I thought the market had gone bonkers. Right. And so I got into a new partnership, raised a fund for a long short fund, actually a fund for with an American partner. And they actually hired me for a long only fund. But I told them, given where the markets are, this is a bubble. I can't make head or tail of what's going on. So I don't want to get into a mandate where I have to beat the markets, because then I'll be forced to do ridiculous things at the peak of the market. And I can't tell you when this bubble will burst. So why did I go into an absolute return strategy instead? This was auspiciously in Jan 2008. And I said, why don't we do a long short fund where the return expectation is absolute return? And that's where the journey started. And as we kind of moved along, what I realized, of course, I had a top-down view because I thought it was a bubble, but I kind of thought about macros and top-down a lot more. And I realized that to actually be successful as a long-short manager, you can't only be a bottom-up person. You need to find great companies on the long side and the short side. But if you're only an India manager, you are correlated. Your entire portfolio is actually correlated, right? So you need to be a dynamic allocator of capital. You need to move to equities conservatively when the markets are going down because it's all correlated, right? And vice versa. So you needed to have an understanding of top-down. Without a top-down understanding, your bottom-up, you will not be able to protect downside when those risk events take place. And the third aspect I realized as a skill set, you have to have an innate risk management DNA. So I think those are the three skill sets. I've seen enough top-down managers who don't do well in India because they don't know what stocks to pick up. They tend generally gravitate towards some of the large cap names if they're bullish. And then I don't think they generate enough alpha. And I've not seen just bottom-up people doing very well because then they tend to lose disproportionate amounts when a risk off kind of emerges. So I think the three skill sets which are very important to be a long-short equity fund manager in India, and that's why you don't probably see that many in India, is you need a top-down understanding, you need a bottom-up understanding, and you need to have a very active risk management DNA.
Yeah, here. I think this would be a great segue to talk about your short book. I know you brought a couple of case studies, and if you want, you can send over the slides afterwards. You can post it up as we talk. You have a long case study and you have a short case study. Maybe since there's so much interest on the short side, it is an art, really. Shorting is an incredible art. Just out of curiosity, up to date, do you remember roughly what the P&L attribution on the short book is? Any given point in time, do you know what that?
Yeah, so you'd be losing money on the short book at this moment. The markets have been up 30, 35%. But I look at my consolidated book. I look at, it's okay for me to lose money on the short side as long as the overall portfolio is making money and I feel the portfolio is de-risked. So if I feel that the portfolio is adequately de-risked and I'm making money overall as a portfolio, I don't mind losing money on the short side. We to elaborate on this. I think there are three uses of a short book, right? Number one, we want to find shorts which generate absolute return. Right? Clearly, so that's the kind of stock picking that we're doing. The second value of a short book is it reduces the beta of the portfolio, right? So it kind of reduces the risk of the overall portfolio. The third utility of a short book is that whenever such large events takes place, right? Because I'm so much risk aware and I'm looking at both sides of the market, I'm able to take a more balanced view of risk as it emerges and basically then navigate those markets from a downside perspective as well. When that downsides happen, I reduce my gross exposure on the long side and expand the gross exposure on the short side. So because of which, we are able to protect that downside as it manipulates. So the three utilities, good.
Yeah, just as a quick one, most managers use index futures as a form of hedging out market beta, but you actually use single names as well, right?
Yeah, we use a lot of single names, but we are not averse to using indexes. So now let's say an event like Israel-Iran conflict. and I want to put on or de-risk my portfolio very quickly, right? So instead of using shorts, individual stocks, I could use an index for a temporary period until I'm clearer as to how that event has panned out. So for such reasons, we could also use index shorts from a time to time basis on a tactical basis.
Okay. So you had three buckets for the short: data, directional, and what was the third one?
Being aware, because I'm aware of the risk on the downside, I'm a little more balanced as far as risk is concerned. And therefore, whenever risk does manifest itself, I'm able to reduce the gross exposure, expand the short book, right? Therefore, reduce my overall exposure to the markets, which helps me to protect downside. See, over a long period of time, stocks go up. So what is the utility of the short book? Right? But there is a utility. I'm not hoping to make disproportionate returns out of my short book. They'll make me returns, but not disproportionate. The disproportionate returns will still come from the long side over a long period of time. But when markets go down, the short book is extremely valuable to protect that downside.
Okay. So let's jump into, one of your short case studies.
There are several, but let's say that I like where an industry is getting disrupted. That's really where the maximum alpha is actually needed. Right? So we shorted a television broadcasting company a few years ago, and basically these companies used to trade at 35 times earnings because they were considered a great way to get to the eyeballs of Indian consumers. Advertising had gravitated to these few channels that were there in broadcasting at that time. But there was a technology disruption, right? So a lot of people moved to YouTube, Netflix, Instagram, and so on and so forth. So the largest advertising beneficiary of India today is actually Google. And the third largest is Meta. So the advertising dollars have shifted to these platforms, and the advertising dollars have actually become subdued for these broadcasting companies. So from 35 times earnings, these companies have now become at 10 to 15 times earnings. What is important to understand in valuation? Valuation is basically the accumulation of future free cash flow to equity holders. But if anybody has done a DCF or a discounted cash flow model, what they will realize is the terminal value is a very important component of the present value, right? And terminal value sometimes can be 50% of the entire present value. And that is dependent on the growth rate of the business for the future. But what if the terminal value, people start believing that terminal value is gravitating to zero? And there is a collapse in valuation in the shorter term. So even though you may not see the profit and loss at this moment be collapsing, but the market has taken a view that the terminal value of this business is going to drop disproportionately, and which means that the valuation or the P ratios drop dramatically. So wherever I've seen technology disruption happening, I think that's really where you get the maximum alpha or the bang for your money. So that's an example of the short. Yeah.
Some of the more market neutral driven type of funds will long short companies within the same industry because they have a very nuanced look at perhaps how disruption may affect one over the other, or maybe there's a competitive moat that the incumbent is not able to overcome. Would you find yourself in those types of shorts? Or would you unilaterally look specifically at company specific, more vulnerable names?
So there are always those as well. If somebody is benefiting from a technology change, somebody is actually losing out. So for instance, one of our largest holdings is a telecom company. And one of the other companies that we shorted was also a telecom company. So both were two independent decisions, but we could see that one is a beneficiary, the other is a loser. So the loser was a 2G player. The market migrated to 4G, and the loser had extremely high debt, which means that they were unable to move to 4G adequately, with the result that they were continuously losing market share, right? And the ARPUs, or the average realization per user, were at the lowest in India. So they had no wriggle room to actually increase prices as well, because the competitive intensity was like that. So we knew that without ARPUs, this company, which is a 2G player, does not have the capital expenditure or the balance sheet to move to 4G, and therefore, over a period of time, that equity value will gravitate to zero, because that would keep increasing because they are making losses, and because of which your market cap kind of gravitates to zero. So that's an example of, as you point out, a long in the telecom business and a short in the telecom business.
So, Rajesh, I mean, maybe I'm sidetracking a little bit. This reminds me of another thesis just last week about AI, right? And I know you don't want to talk about your book, the current book perhaps, but one of the ideas I heard was longing mainstream AI and shorting a software as a service company, especially those that would be heavily disrupted by AI. Is there a similar type of short idea across in India, especially given its leadership in the software business or in like the call center business where AI could be disruptive, just out of curiosity?
I think the software services companies will eventually be beneficiaries of the AI spending that is taking place. Of course, the productivity will go up, pricing will probably come down for them. So there was actually some feeling whether the software services companies could get disrupted because the workload now that you require, the programming that you require would be far lower. But I don't think that is the case. I think the work quantity will actually go up. The productivity of these companies will also increase. They'll have to move towards the higher end of the value chain, so on and so forth. So that's not an area where things are getting disrupted. On the other hand, look, we don't have as many plays on the AI space, but what is happening is the data centers. The data center business is exploding, because of which you'll require gensets, because you'll require EPC players which can make the data gensets. It's a real estate play. And utilities, because of which now you require a lot of power. So I think on an AI play, those are the type of companies that are benefiting from the AI explosion that is taking.
How do I look at then? I mean, if not AI in terms of hardware manufacturing, such as GPU, but more on the data center side, do I look at that more like a utility, as you mentioned, and more as a utility play over time? And number two is, are there any concerns about commoditization as code becomes more optimized and efficiencies start to grow as, more of this Capex is kind of works its way through the system?
So, we always look for a moat when we're looking at least if we're going long. So typically what I've found is in the product space of engineering, I find those are the companies that will have the moat and that will benefit from data centers. So for example, there's a company called Cummins which supplies power gensets, backup power to the data center business. And it's a product company. So they will actually benefit from the rise of data centers. The data center business per se as such, that's not something that we have gravitated towards.
Oh, that's brilliant. So it's kind of like reinsurance in a way. We can talk about your long idea or one of your long case study from a few years back. In fact, give us a sense of how you look, how you evaluate companies.
So typically, in my strategic long, I am trying to buy, like I said, companies with a multi-year thesis and where the predictability is also reasonably high. So my largest holding has been a company called Bharti. Now, as I pointed out, basically this was a business which had 12 players in 2008, 2009, all telecom services companies, right? Just like China Telecom, right? Or a Verizon. So basically there were 12 such companies, right? The second largest market for telecommunication services, mobile telephony, 100 crore, a billion consumers in that space. And it's a consumer business, right? A B2C business. So there were a lot of people that came into that business, but rates dropped very sharply. In fact, rates dropped to lower than what they were in Africa. So a lot of these players had to exit the business, right? This was a phase of, like I pointed out, when the banks were saddled with large NPAs, right? Non-performing assets. Telecom was one of the significant contributors to that non-performing assets. So then you were left with 2.5 players. I say half because the third player was saddled with a lot of debt and it was a 2G player. And
Well, so hold on. It went from 12 players to 2.5 players?
Yeah.
My goodness.
So it consolidated massively, but yet the prices went at the lowest point in the last 10 or 12 years. Prices had just gone one way down because of the intense competition, right? But Bharti, within that matrix, had captured the highest ARPU, the best customers, the most premium customers, right? Which are not as price sensitive, fortunately. And what we realize is now that this market is consolidated, there's only one way that the ARPU of 120 rupees, which is like $1.50 per month, can only go up, right? So in the last 3 or 4 years, that 120 rupees has gone to closer to 200, which is like $2.25 a month. That's all that Indian consumers are paying for all the data and the telecommunication services that they are using, right? And by the way, the $2.25 can go to $3.5.
I don't
But
even want to tell you what my bill is this month for telephony, for mobile.
I can understand, So somebody in the US pays a minimum of $60 per month.
That's right. Yeah.
Yeah. So even if you go to $3, right? See, what happens in a business if you increase the prices and don't increase the cost structure is that all that realization just drops to the bottom line. And we have just gone from the journey of 120 rupees to 200 rupees. That $1.5 to $2.25. We are yet to go to $3.25, right? And in that space, what has happened is Bharti telecommunication has gone up over 4 times for us in the last 5 years, right? But I think this is just half the journey. Just yesterday, one of the ministers was saying that the prices are ridiculously low. So there is support from the government to raise tariffs, right? Because the government can see that if I don't encourage more players to come up, which is the third player, they want to repair the third player. They don't want only two players to dominate the digitization of India.
It's a duopoly, exactly. It's a duopoly.
So they want a minimum of the third player. That third player can only repair its balance sheet if they have higher realizations. So the government also sees that for the need of that, and government says, I need healthy balance sheets in the telecommunication space because this is where the digitization of India is going to take place. And by the way, I need them to spend money on 6G when it actually does happen, if you want to keep ourselves ahead in the technology race. So all of those reasons, we've just gone from point A to point B, and we have to move to point C and probably point D as we move forward. So there's a lot of upside still left in this story.
I think what's remarkable is that this is an environment that's really conducive towards a healthy type of inflation, which is really exciting because when you have healthy type of inflation that's driven by productivity rather than through spending or debt, it's quite incredible. I mean, just generally, I think the number I saw for BRICS, the total BRICS contribution to global GDP was more than 70%, right? Whereas developing nations had, in combination, had less than 20% contribution if you choose the US plus the top 3 or 4. Let's not even talk about certain parts of Europe. With India now moving into this next phase, and we touched on demographics a bit, you probably seen the news, pretty much every part of Asia, be it Korea, Japan, Hong Kong, China, we're all shrinking populations. But you pointed out that the working force is actually growing and contributing to a very significant part of global, not just India, but global workforce as well. What about the bear case? Is there a bear case? Let me put it this way. What keeps you awake at night, when you look at where we are? And I asked this and linking it back to how you were able in 2008 and 2020 sort of see emerging risks and how to manage that risk. What would trigger you or what would flag a serious rebalancing of the book?
What is normal cycles? We're all prone to excesses. I should tell you that in India, between 1996 to 2003, you made zero returns in equity. Between 2008 Jan to 2015 Jan, 7 years, you made zero return on equity. So you can have 6, 7, 8 years of no returns because of excesses which correct themselves, right? So that's one. We should always remember that nothing goes to the sky and cycles will always manifest themselves is number one. Second is, I think we are moving into a more fragile geopolitical environment. You look at what's happening with Russia, Ukraine, now the Middle East. The last thing you want is China attacking Taiwan and we want Third World War III. So basically the geopolitical fragility is something that needs to be watched. I don't know whether it's the social media, but I think the noises are getting very one-sided. People are taking ideological themes to heart. And I think people are kind of, even in India, and I can see that in the elections in America as well, people are taking very radical views. Maybe it's also instigated by the social media phenomena that we have. But geopolitical...
Do you see that reflecting in how allocators are voting with their dollars as well?
Not so much. I don't think people are thinking as much about, at least not in India. People fortunately, India is still very cohesive at this moment. But I think increasingly, I see the political rhetoric in India is also very, very divisive, right? And that's not necessarily healthy, but I can see that across the world as well. So geopolitical tensions is something that you worry about, and we just hope that it doesn't lead to wider conflicts. I would say the financial engineering of the entire system, the money supply that has been pushed into the system by the top 10 central bankers, which has resulted in a collapse in the cost of capital, is something that you worry about as well, because you're artificially propping up asset prices. And fortunately, it has not resulted in inflation.
It's
But
supposed to result in a debasement of the currency, actually.
right. And I think the central bankers are now at least all incentivized to keep real interest rates low. So because they have such large borrowings. So the fact is that you're moving into a greater, more fragile financial environment as well. Right. And lastly, like I pointed out, India specific, we are getting a little more divisive. Fortunately, the last 10 years, the central government has been the same. It's the same for the third term as well. But there was a temptation to offer a lot of things free. The way the opposition wants to come to power is say, we'll give you power free. We'll give you 2,000 rupees per month free. Everybody gets freebies. Now, who's going to pay for all that? That's actually regressing to socialism, right? So then you'll stop growing the cake. And, because you have to take the cake from somebody else and give it to these people. So there's actually a fear that we have not developed a consensus on capitalism. And if ever we were to gravitate to policies which are not capitalistic or pro-business, fortunately they have been in India for the last two governments and the same government, but if that government were to change, and if you were to have a very left ideologically inclined government, I think you could see serious collapses, right? So it's unfortunate that we have not yet driven a consensus around policy making, at least as far as capitalism is concerned.
When it's just on politics, I think in a way, India really is enjoying its position being in neutral. It's publicly declared it as a neutral party, both in its voting at the United Nations as well as its dealings with both Russia and across the Middle East. You're right. Every manager I talk to does have a general concern, regardless of who starts the conflict. The one that Western media seems to be pushing is more wary of is U.S.-China, even though all intents and purposes, we're already in the middle of a massive conflict if you count both Middle East and what's happening in Ukraine. I believe at the time Ukraine was projected to, the Russia-Ukraine war was supposed to end within 3 months is what some of the pundits called it at the time. We're now moving into year 3. And, one of my analysts mentioned that the average lifespan of a war is 7 years. We're pretty much going halfway into the, Ukraine-Russia war. The Middle East is just starting. How that creates a contagion effect for the rest of us in Asia is something that, well, at this point, really, if anything, it really just benefits, the U.S. The U.S. is now the major exporter of energy to Europe, and its military complex is the major benefactor of UN-certified military supplies. So I guess that's great for the allies. For those of us here, I guess what's interesting is that productivity is still very, very high, though, having said that. And be it China, it's a different world now. China in the last 2 weeks, you're seeing a bump in the markets, fiscal policy opening up. India is no stopping India anytime soon. When you talk to allocators from overseas now, who, for the most part, when I talk to from the US and even parts of Europe, there's still a great home-based bias. And I find it interesting because 10 years ago, when for those of us in India and Asia who are raising capital in the US, there was a lot of talk about diversification. They were asking us to diversify, and they felt that it was in their best interest to diversify. But that diversification was primarily between US, South America, and Europe. I actually rarely hear Asia as a major component in their books. Are you seeing any shift in that lately? I mean, are investors and allocators coming around to be less disproportionate about their allocation to emerging markets?
Fortunately for them, the US markets have been doing very well. I mean, there are a lot of assets that have been doing well. Gold has been doing extremely well. The US markets are doing extremely well. Japan, until some time ago, was doing well. Germany and France until some time ago, were hitting new highs. So they had plenty to kind of look forward to. And they didn't have to come to the certain markets like India, which for the last 2 years, a lot of foreigners have been feeling is overvalued. So fortunately for them, there were a lot of options in the menu to choose from, and they could kind of ignore a country like India. And so in the last 3 years, we haven't really seen any major FI participation or foreign institutional investor participation. Actually, the markets have been driven more by domestic investors rather than foreign investors. Having said that, I think a lot of investors are, when they're talking to us, they clearly want to invest in India, but only if it were available cheaper, So I think
What does that mean, cheaper? Are there capital controls or tax issues that we need to be concerned about, especially for those of us who are coming to the region for the first time?
I'm not even going to whether the taxation is higher or lower. Actually, the capital gains tax in India is extremely benign, I would say. The long-term capital gains is 12.5%. The short-term capital gains is 20%. So it's not as prohibitive. In fact, if an investor from Hong Kong or Singapore, I understand the capital gains is probably zero in those markets. If they were to come to a gift city product, the taxation is even better because the gift city where taxation is even lower. So I don't think taxation
Oh,
is
just John, just maybe for our audience, Gift City, and just for those of us who are here for the first time, Gift City is a special administrative region where the government has set aside specifically for vehicles like fund structuring to compete with the likes of Cayman. Is that an accurate description?
Sure. It's a jurisdiction where they are encouraging foreign institutional investors to participate from.
And your team has actually just launched your first US denominated or offshore fund, which will give international investors access to the domestic strategy for the first time.
Yes, my team has launched a product which is live starting Jan of this year. So,
Congratulations.
Thank you. Thank you.
Just maybe a couple of, I guess, more intimate questions. When you strike me as someone who has had a very, very thorough, not just pedigree, but a career in both risk, bottom up, macro. It's extremely thorough. I think that's the best word I can use to describe. But you're also kind of running a fund in a way which is like running a business. If you were to give advice to someone who's starting their fund now for the first time, or maybe if you were to give yourself advice knowing what you know now, and you were to give yourself advice 6 years ago, what would you tell yourself?
About investing?
About investing, about setting up a fund, about things, maybe something that you would have done differently or felt you could have done better?
So my learning in the business of investing particularly is keep things simple. Use common sense. I mean, I cannot overemphasize this. Every day you get up, you have to tell yourself, keep things simple, use common sense because there's just so much noise out there, right? And to make you the best judgments require clarity of thought. So you have to strive for clarity of thought. That conceptual clarity can only happen when you keep things simple and use common sense. That's number one. Number two, to make disproportionate money, either you require a long time horizon or you have to think ahead of the market. To think ahead of the market, you need to have an original mindset. You cannot borrow ideas. You can listen. So the entire business is really about observing and listening, right? The entire business is all about observing and listening, which requires humility because it may interfere with the current judgments that you have. So let me give you an example. What do I mean by observe? So I told you that the entire market rise was driven by domestic investors. What we noticed is the option value trading of the Indian market just went through the roof. Now, when we observed that, what could we learn? The exchanges are going to benefit disproportionately, right? Because all of that is being rooted through a business which is almost a monopoly, right? It's a duopoly actually. So the monopoly is getting disproportionate rise in business multiple times, right? So when you observe that, you have to listen that that's where the opportunity is, right? And by the way, those stocks are 6 or 7 baggers in the last 2 years, right? So that's the business. Observe, listen, and come to conclusions which are independent. Think ahead of the market, keep things simple, and observe. And there are many. I mean, there's a book called The Most Important Thing, which Howard Marks wrote. And in every newsletter, I would say the most important thing is action. The next letter, I would say the most important thing is. So in investing, there are a lot of most important things. But that's a summary of what I have learned, which works in investing. And think long term. I would say that have a full cycle view of your portfolio. And nobody's smart to figure out what the next 2 days are going to look like. So think, if you're at least a fundamental investor, think about how, even if you're trading, how the trade is going to move out for a medium-term period.
Thank you. Thank you, Rajesh. I think those are words of wisdom for myself and many of our viewers who are watching. You mentioned Marx as one of the books that you look to. Any books that you're reading these days? Any good novels you picked up?
So, I mean, I think the best book on investing was written by Seth Klarman. Margin of Safety, I think, is the best book on investing, according to me. The second best book in investing is Essays of Warren Buffett. I would say that's a fantastic book. Of course, Howard Marks writes extremely well. If you're a fundamental trader, I think the best interview that you can read is by Jim Rogers in Market Wizards. It's one of the best fundamental trader interviews that I have read. There's just so many. But
Jack Schwager wrote The Market Wizards.
but the best interview that I found was really Jim Rogers. And I think he's a remarkable fundamental trader, which is what we are also as a long short fund. So there are many to learn from, but I think those are the ones that really come to mind.
This has been an incredible hour and a bit with you, Rajesh. I think it'd be great if we could do it again sometime. Really enjoyed it. And as we move into this fourth quarter with India, I can't shake the feeling that investors are just not sufficiently bullish on this region. I'm sure that's what you've been, hammering at the table for this year. So congratulations on your success moving into your 6.5 year. It's been an outstanding 2024 for you, and I wish you all the best. And we'll talk to you soon.
Thank you so much for your time.